A lot of people are right now wondering if the tech space is significantly overvalued. Our guest today is John Tinsman, who's an investor and a big believer in the US tech. Despite the fact that his family has had a big fertilizing company, he's here to tell us what he sees that's so special in the tech companies in the US and where this space is headed.
Investors have to be very careful going into the future and investing, by the way, in foreign markets. Like China has a horrible demographic problem, and the problem is really masked because you're still counting the people that are in the older generation. So you almost sometimes it looks like the population's not falling at all. But what you really have is a working base that's going to become 1/4 the size of the retired base. And so you're going to have inflation be you're going to have innovation rates be 1/4 of what they used to be. You're going to have 1/4 the amount of consumers to sell to because the retirees really aren't the consumers.
I'm Siamak, and this is Market Insider. John, it's great to have you on. Welcome.
It's a pleasure to be here. Thank you.
We want to talk to you about the economy and where the investments are headed. You're an investor. You've been investing in this economy. Can you tell us what you see out there?
Right now, I see that the biggest upside continues to be probably in that US technology space. And when I think about investing, I see low levels of debt in this area. I see enormous potential for growth. I mean, the analysts at the investment banks expect the information technology sector to grow their earnings at 28% year over year. But I also see the highest level of scalability. What I think is really unique about like the large cap US technology space is that these companies are enormously profitable, very high profit margins, but they're very scalable at the same time. So additional sales come at very low costs. And also they can innovate because they have such high profit margins. They have so much cash flow for innovation. And that means that these companies can innovate at 100 times faster than traditional companies and then do what American tech does best. They build it in the US and then they sell it to the rest of the world at enormous profit margins, which is great for shareholders.
Can you elaborate more how the business model works?
So the traditional business model is one of high marginal cost, right? So when you build a car or when you build an airplane, you have to buy the steel, you have to run the factory, and it's very expensive. And basically of each past sale, you might need to take 99% of that and reinvest it just to build the same product again. Now, what US tech has really done is they've rewritten what you can do in a business. Each additional sale that they have comes at 100% profit margin. So one additional unit of Microsoft Office actually incurs no additional cost for Microsoft. I mean, think about it. If you go to their website and you download it, they incurred no cost producing one additional unit. That is the definition of low marginal cost. What that means then is that there's also no cost to scale the business. So if the demand exists for people to want to use Visa credit cards and you keep swiping your credit card, there's really no limit to what that demand can scale to. Conversely, for Ford to meet demand is very expensive because they have to build new factories. Then they continue to sell at very low profit margins. You're just seeing the mathematical probabilities of the long-term payoff is much lower. What has really helped California and the US succeed, I think, in the last decade or two is having these businesses that can sell products at high profit margins, that can innovate very quickly, but also make these products that can scale across the rest of the world and provide value to an enormous, billions of people due to their scalability, which is just that it costs nothing to continue growing. I think that we all need to be thinking about, when we invest, what businesses have this high upside potential and how as the US can we continue to protect these businesses and enable their success.
Is it different valuing these businesses compared to the traditional ones?
Well, businesses that can reach very high profit margins, right? When you think about like Visa, you're talking about 50% plus. There's companies out there like AppLovin that are reaching 70% plus profit margins. When you value a business, you try to figure out, what's their future cash flow and what is the profit margin on that cash flow. You end up with businesses that get valued at higher price to sales metrics compared to traditional businesses like Costco, right? Which might have a price to sales of 1, precisely because their maximum profit margin might be 2%. You might have a business that could have a mature profit margin of 50%. By some traditional metrics, like price to sales, it looks like the metrics are higher. And you can see actually when you look at some people saying that the stock market is overvalued, they literally put up things like price to sales. And they say, look at the price to sales of the S&P 500 is higher than it was 2 decades ago and 1 decade ago. Yet they leave out what proportion of the companies in the S&P 500, like NVIDIA, can reach just enormous profit margins. So some of that is mathematically based. I mean, if you can capture 50% of the sales as a profit margin versus 2%, you would expect to see the valuation metrics go up to reflect that reality that you're capturing 25x more of the revenue as earnings for shareholders. To me, it's not overvalued. To me, we have very high growth in that expanded technology space. And we also have extremely high profit margins. Companies like Google are growing their earnings at 50% year over year. And what we've really seen is an acceleration in earnings growth and an acceleration in revenue growth across much of the US technology landscape. So the market was great for investors in 2025. And I believe those strengths are only growing and continuing into 2026.
What indicators are you looking at? What do you see that is showing you a lot of growth in 2026?
Well, when I invest, I have an ETF company, so I invest in a portfolio manager for two ETFs, AOTG and AOTS. I like to invest in the highest growth in the market. When I find the highest growth in the market within large cap companies, those are companies like Robinhood that are growing their revenue at 100% year over year. Companies like Google, which is 50% year over year earnings growth, and companies like AppLovin. I really look for within that large cap space, the best earnings growth. And I believe that is, a sign that these companies are very innovative if customers are clamoring to get their hands on more of their products or services. Other thing I look for is low marginal cost. So that goes back to what is the cost of an additional unit of sale. You used to have businesses like, take, for example, the brokerage business. It was very labor intensive. You needed a broker for each customer. But now you have a software company like Robinhood, and I know that they're in the financial services, but let's be honest, it's software that helps them automate their brokerage services. And then they automate those services. They provide the savings to the shareholders and to their customers. I mean, let's be honest. Robinhood was the first company to ever charge no commissions in transaction fees on stock trades. So these are extraordinarily innovative companies. They're doing what no company has ever done before. And then they're using software to automate, scale, and reduce the costs and barriers to entry. So that just provides enormous value. And then you can see Robinhood right now scaling across the rest of the world, bringing on huge numbers of European customers. So they're maintaining that growth as they scale. They've created this good software brokerage platform, and then they take it across the rest of the world and sell it to the rest of the world at high profit margins. So that's what I look for: low marginal costs and high growth. And the biggest thing about high growth is, what's the benefit of low marginal costs if you have no additional sales? Because the additional sales come at 100% profit margins. So I think for investors to do the best, not only do they need low marginal costs, but you need the most additional sales as you can get to stress that benefit. So that's why I target what I do.
In terms of the companies, you mentioned that they can have high growth and innovate. How do you find out that they're an innovative company?
So simply that the revenue and the earnings growth is there, right? If you have a company that says they're going to cure cancer and yet they have no revenue growth and no earnings growth, clearly if you had cured cancer or cured sickle cell anemia, et cetera, you would have enormous earnings and revenue growth. So when you look at the data, it certainly points to that.
How did you get to this conclusion that the tech companies are worth more? These are the ones you should invest in. Because right now, there's a lot of other companies that have a very low multiple. You get the Verizons of the world or Costco's or Chipotle's that have a very low price to earnings multiple.
Yeah, so I have a family fertilizer business, and I've been involved in that. And it's a manufacturing business based here in Iowa. And so it sells fertilizer products across the Midwest. What I've learned about that value business is that it's very expensive to grow, right? So if we wanted to grow, we could build another fertilizer factory and open up 10 new retail locations, hire hundreds of employees, and you'd be spending hundreds of millions of dollars to do that. And then once you had that base in a new territory, say we're going to go into Canada or something, then you also have to sell your fertilizer to loss just to start winning business, because the existing players in that market aren't just going to hand it over to you for free. They're going to say, over my dead body, and they will fight like it's a fight for survival. So now you have all this growth just to sell products at massively negative profit margins. And so basically what you end up with is these companies that say, you know what, we're not going to try to grow at all. We'll just spin off a dividend. Well, when you're an ambitious person, you think, I'm going to own a company that is not going to be any bigger in 10 years. And then you recognize that over half of the S&P 500 is made up of companies just like that. You'd say, well, that's not the way I'm going to be better off in the future. Why don't I just focus on the companies that do have that growth potential that we will need more of in 10 years, and that we'll see their additional sales come at very high profit margins. So mathematically, that makes a lot of sense to me. I started investing. I've been doing it my whole investment career, but really in 2010. And since in that time, I liked purchasing companies like Microsoft and Apple and Visa, but I also bought some traditional companies like Boeing and Ford. And I just noticed that those low marginal cost buys, those technology-oriented companies, outperformed by over 2,000 percentage points my basket of companies that didn't fall into that basket. So when I sat here today and I asked, how am I going to make this decision to invest in the future? It was going to be investing in what I think is the lowest amount of risk and the most amount of upside. So as I was investing for myself and my family, I eventually rolled the strategy into an ETF and started AOTG ETF, the AOT Growth and Innovation Fund, in 2022. ETFs, actually, when you're investing in an ETF and you're managing the portfolio, you can sell appreciated positions like NVIDIA without recognizing any capital gains for shareholders. So that's a huge benefit over doing it in a brokerage account where you would be recognizing large capital gains and then giving up that performance and paying a large tax to the government, which might be in excess of 40%, which significantly lowers the long-term performance, especially when you compound that year over year. So the ETFs is a very innovative product for the U.S. consumer. It is extremely tax efficient, and it's really just about creating about as much value for shareholders and as much return potential as possible. And so that's why I'm in the ETF business. I own, with almost all my own money, my ETFs myself, and I believe that it's great for investors to target U.S. growth and U.S. technology as investments because they've historically been like some of the best returning sectors ever. But those strengths that made them the top performers, I believe, continue and only strengthen into the future.
You are optimistic on the U.S. growth and U.S. technology. What are your thoughts on inflation? Inflation,
I believe, is really tied to, and the data points is tied to the government deficit. So it's important to have a government that can control its spending. I think it's important for the Republicans, or, if someday the Democrats regain power in the administration, it's important for them to focus on limiting their government spending to what the taxable base actually is. We've seen that deficit shrink significantly. So we've seen inflation rates fall. And I think it's good to see that. And I think President Trump was putting pressure on the Federal Reserve to lower their interest rates, which I think was quite necessary. The interest rates at the United States were 4.5%. We have to remember that. And meanwhile, the rest of the developed world, many of them were close to zero. So we saw Switzerland at zero, Japan near zero, much of Europe well under 2%. We even saw China at 2%. And we all know that Chinese bonds are riskier than the United States. So the question is, when you have these high interest rates and every consumer is maybe paying 2% more, 2.5% more than they should on their mortgages, on their student loans, we know that's weakening the American consumer, and it's leaving a lot less money in the pocket, perhaps for no good reason at all. Perhaps the rates were being held artificially high. So now we've seen the Federal Reserve start to lower their interest rates. I think the natural place for interest rates to actually go, though, is back to zero, as we saw briefly before COVID. And my belief with interest rates heading towards zero is simply when you think about the demographic issue, and I believe like there's more baby boomers than there are in the youngest generation. So you see that there's going to be, in the future, there's going to be more lenders. So let's say you've got the baby boomers, and these are the people that have their money in their accounts. They want to lend it out so they can earn an interest rate as maybe they feel equities is too safe or too risky in their retirement. So on the flip side of that, you have the youngest generation, which needs to buy cars, which needs to buy houses, and they're the borrowers. And so when you have a lot more lenders demographically than you have borrowers, you see that the interest rates actually get pushed negative, as we saw in much of the developed world before the government deficits exploded and crowded out the borrowing. So if the governments around the world, the Western world, can control their deficits, then I believe you see interest rates fall back to zero. And this would be phenomenal because we hear in many of these countries that there's a cost of living crisis for younger people, that they can't afford houses, they can't afford cars. But never do you really see politicians or experts point it back to the government spending. But when I think about it with common sense, we see these enormous government deficits and they're crowding out the borrowing market, making it much more expensive than it should be for young people to borrow, creating that cost of living crisis, or at the very least contributing to it. So I believe the right place to go is to balance your deficit and allow rates to fall back to zero or under zero even. And that would enable the youngest generation to really succeed. And it's the way in a supply and demand market, rates would fall mathematically. If the government goes towards running a balanced budget, then I would believe rates would naturally fall to zero and inflation might actually turn into a deflationary environment.
You mentioned demographics. What are your thoughts of the impact of demographics in the U.S. on the future of the economy?
I think that when you're investing, demographics affects everything. So if you have fewer consumers in 20 years, how is Coke going to do? You're going to have less people drinking Diet Coke or Coke. You're going to have less people using the water utilities. So I think what you have is a problem that becomes created in investment in that these companies have a shrinking customer base. They have fewer number of people to sell to. And naturally, you'll see a decline of revenue and a decline of earnings when you adjust for inflation. When you're investing, I think it's important to focus on what gives you the potential to do well long term. And you can see that that's really changed. Like when I think about investors that did really well, think about like Warren Buffett. He bought Coca-Cola when people used to go to the soda fountain to drink a Coke once a week. And he realized that, I became wealthy. I say I as Warren Buffett. I drink Coke every day. I bet everybody else will become like me and we'll all drink Coke every day across the world. And so he found these markets with 1,000x growth. He bought insurance companies before it was mandated to have insurance for driving your car around or for having a mortgage. So it went from something that got used 1% of the population to 100% of the population, and the population quadrupled. So he had these amazing sectors of growth, but some of that growth was merely demographic led. Investors have to be very careful going into the future and investing, by the way, in foreign markets. Like China has a horrible demographic problem. And the problem is really masked because because you're still counting the people that are in the older generation. So you almost sometimes it looks like the population's not falling at all. But what you really have is a working base that's going to become 1/4 the size of the retired base. And so you're going to have inflation you're going to have innovation rates be 1/4 of what they used to be. You're going to have 1/4 the amount of consumers to sell to because the retirees really aren't the consumers. They're not the ones buying new cars and buying new houses and taking out loans. So you just see a large slowdown happening in every sector of what is beneficial for investors. I would stay focused on the areas of the market that not only do we need a lot more of in 5 to 10 years, like software and semiconductors and hardware, also are protected the most from that. And so there's products that you can make that provide a lot of value to people that then can go and scale across the rest of the world to provide value to everybody. These might be coming from countries that have bad demographic growth. You could have Spotify in Sweden that scales all across the rest of the world. But if you see that the growth is there, then those are the companies to try to invest in to avoid some of the demographic growth that's going to hit a lot of the traditional industry.
John, right now, Magnificent Seven, they're 35% of the market or more than that. Some people argue that we're in a tech bubble and we're in this AI bubble because the valuations are extreme. What are your thoughts on that?
Have you seen the earnings growth amongst these companies? Companies like NVIDIA have a diluted GAAP earnings per share growth of 1,800% compared to 2 years ago. So these companies are actually earning just an enormous amount more across the Mag 7. I mean, the exception is probably Apple. I think that's the first thing. The second thing is, a couple of years ago, do you remember people saying like, oh, Apple has more cash on their balance sheet than the US government? These companies were loaded up with cash. And we know when you just hold cash in US Treasuries, that's not a good return on your investment. It's very low. So what we really do is not wanting these companies to just hold cash, but to continue to invest in innovation across the world and to build these incredible products in the US and then export their services to the rest of the world. So I think what we've seen with AI, one, is that we've gotten these companies back on the offensive, that they're not afraid to make investments anymore. And the Trump administration has really opened up the markets to feel like these companies can be have the confidence that they should go out and start using some of their cash pile to invest in U.S. innovation. I think that's the first thing. The second thing is that they're all earning a lot more. The third thing is let's just talk about AI and what we think is obvious AI can do. So would you agree that with AI, instead of having 100 software developers, maybe you could do just as much with 10 software developers writing a lot of AI code, but then managing it and implementing it into products faster? Do you agree that might be a good possibility? So now you're talking about reducing your costs by a factor of 1/10 the costs. If we know anything about reducing your costs, we know that conversely it means your profit margins are higher. That's the first thing. So lower costs usually leads to higher profits. So that's great for investors, and this is changing the landscape. We've seen companies like Google and Apple and Microsoft and Amazon doing layoffs as they do reduce their costs. The next thing we would say is, would you agree that AI has the strong possibility of increasing the rate of innovation? You have companies innovating faster at lower costs. This is a very positive development in this investment sector, but also for the country as a whole. It's just very exciting. I think what we need to make sure we do as a country is to try to stay out of the way of these companies, not overregulate them, but allow them to do what they do best and protect them in international markets. There's always countries that might be jealous of their success and want to tax them or limit their products and services to protect their own their companies. So we need to enable them. We need to help their success. And we need to be fully behind them, because this is going to continue to improve American prosperity. And it's also going to create great returns for investors. And we're all invested in U.S. tech at the end of the day when you own funds like the S&P 500 or the NASDAQ 100.
Take us to the time that you found out that this low marginal cost of additional units has a huge impact on these businesses.
I would just say that I realized that even within an ETF business, there's no additional cost of sales. And just like in Epoch Times, you can bring on double the amount of subscribers, but that doesn't come with double the cost. And I took a look at our family fertilizer business and realized that it would be impossible to double the sales. And I took a look at things like the Vanguard Value Index and realized, wait, this is why these funds really haven't gone up much at all in the past decade. Meanwhile, the tech index has been annualizing 20% a year. So I noticed that there was things that I was seeing with my own eyes in the management of a business. I have a low marginal cost business, but I also, am a family member of a value high marginal cost business. I could see it in my investment accounts as well. At the end of the day, I'd say all of my personal experiences, all of the data in the stock market points back to these sectors of the market don't make for good long-term investments. It's not that I don't love Costco or love Boeing or love Ford, and I want them all to be successful. The fact is I don't believe mathematically they offer anywhere near the same upside as low marginal cost, right? Like NVIDIA grew their earnings by 18 times. There is 0% probability Ford could grow their earnings by 18 times over the next 2 years. It doesn't exist. It skews the risk reward dynamic. But then think about this. Because these companies are so in debt like Ford, because the growth is so expensive, the second there's a downturn, they're nearly bankrupt. So they're also, not only do they have less upside, but they have way more risk. When I invest, it's really about maximizing the upside and minimizing the risk. And sometimes people think about technology is risky. They think, oh, this is more volatile. But in reality, it doesn't really matter to a long-term investor how much something goes up or down in 1 or 2 days or in a week. What really matters is a multi-year period. And because there's so much revenue and earnings growth over a multi-year period, I don't really see the risk being there that they fall in value, especially when you focus on the profitable companies. So there's a confusion when tech, I think that you think about the NASDAQ during the dot-com bubble and that the NASDAQ imploded. But back then the NASDAQ was super unprofitable companies that were making no money at all, trading at high valuation metrics. Today, we have the most profitable companies on earth, right, in the NASDAQ. It has a profit margin that's 30% higher than the S&P 500s. These companies are innovating faster, they're more scalable. You also have very reasonable valuation metrics, right? Like Warren Buffett was just picking up Google at a PE ratio of 18. So these are not overvalued, I think, by anybody's, or at least not by by investors in my sector. I'm not going to say anybody, but I believe that they're very fairly valued, especially considering their accelerating revenue and earnings growth rate. And I believe they continue to offer a great opportunity for investors to invest in.
John Tinsman, the founder and CEO of AOT Invest, it was great to have you on Market Insider.
Thank you so much. It's a pleasure to be here. I'm happy to come back anytime.
Do you agree with John about US tech companies? Or do you think they're overvalued and there are better opportunities in the market? Let us know in the comments. I'm Siamak. This is Market Insider. We'll see you next time.